Hello, guys. This is Mickey Blindside, and this is an emergency video that I'm putting out on the early morning. It's right now a little bit past midnight here in the Eastern Time Zone on June 10th. I'm just doing an emergency video because we just saw some interesting price action at the end of the day today, with a lot of the equity indices selling off. So I just wanted to give an update to my plan. I still have, thank goodness that I got these UVXY call spreads for December. I wish I bought some more. I wish I had some more. And I was planning on buying 10 to 20 a week. I bought 10 this week. I thought maybe later this week I'd buy like 5 to 10 more. It doesn't look like that's going to happen, but at least I have some skin in the game. My main hedging was going to be with the most likely IWM or the triple Q put spreads that are 6 months out. That was going to be my main hedge if the markets drifted higher. But we don't always get what we want. So again, we can't predict the future, but we can just anticipate what's going to happen based on what we see and based on the data. Okay, we're just anticipating just in case if something does happen. Okay. I entered a small lotto on SPY end of day. Timing could have been a little bit better. I'm not gonna lie. And some people asked me on DM, hey, why? You already have a lotto on XLF, which is pretty much just tracking SPY right now. It does about the same. I think today SPY is down 2.38 and XLF was down about the same amount. So people are asking me, you already have an XLF lotto. Why enter another one? And really, this is a hedge for my hedge. Now, on Wednesday, on Twitter, as well as in the equity indices channel on the Discord, I wrote about a spread that was bought on SPX in the wee hours of the morning at 5 in the morning. Somebody bought the 4250 calls and sold the 4300 calls, essentially creating a vertical debit spread for a premium of 3.7 that could potentially pay out 50. So, and I explained in that video that most likely it's some institution who's already hedged and they're hedging their hedge. Now, why would anybody want to hedge their hedge? Because, if you, hedging, if the hedges don't pay out, it just becomes a drag on your portfolio. So if you own SPY and you hedge by buying puts, well, if the market just keeps going up and there is no risk event, well, those puts are going to go worthless, and so it drags your portfolio performance down. So one of the things that I was worried about is if tomorrow's CPI report comes out, not as inflationary and the numbers are better than expected, and the market takes it very well. What I'm afraid of is that on UVXY, this may fall into the 1110s and into the single dollar, like 8 or 9 or so, and within maybe a month and a half, and then there's going to be a reverse stock split. So that means I'm going to have to get out of this spread. And if you look at the bid and ask, it's kind of wide. So getting out of this and re-entering this is going to be expensive. So I wanted a way to pay for this. So this is my way of hedging my hedge, just like that trader did, and on SPX, I think that's what they did. For that much money, it's a $296,000 for 2 days, for a 2-day expiration spread that could potentially pay out $3.7 million. So I'm guessing that's that's a hedge for their hedge, and this is also my version of a hedge for a hedge. I only have 10 spreads on UVXY. That's all I could get. This, I only had, I told everybody that I only used about 25% of my profits for NEO, which comes out to be about five. I bought about five of these. So it's about half. So, potentially if the market goes up and if we have a risk off, a risk on event where the inflation numbers just, aren't that bad, definitely we can see this going up. I don't know, maybe to 40, 50 cents each. That would give me plenty to get out of my spreads here. So that will pay for my exit. Like I said, I'm going to have to pay a spread to get out of these. The spreads are so wide, it's probably going to be expensive to get out and get back in after a reverse stock split if it were to happen. So it's a cheap hedge for my hedge. And that's kind of the reasoning why I did that as well. So it's kind of a lotto, but it's also a hedge on my hedge. So we shall see what happens. Now, I also said, too, that if we break this level right here, we're going to see some fresh hedgers, and that's what happened. Once we broke this level today, we saw a lot of put buying, like just out the money put buying happening on the S&P 500 index. I mean, just the delta zeros to 20s. We saw a lot of 4,000 puts expiring for tomorrow. 3,900s just getting bought ferociously. All right. So tomorrow, my plan is this. If we break, right now there's still a big put wall at 4,000. If we break 4,000 and VIX is still spiking, I may enter some spreads at that point. I don't know which one I'm going to do, but if I see that we're breaking, breaking that, I may go with SPY or maybe SPX. Let's look at SPX, actually. Maybe I do SPX. But, I might go out just like 3 months or so, because if it breaks 4,000, I think it's just going to continue down to the downside. The institutional value buy level on S&P 500 right now is between 3,500 and 3,600. And a lot of professionals are going to agree on that number. And the reason why they're going to agree is because it's all based on math. It's all based on financial modeling. All right. We have a member here who does the financial modeling for, I believe, is an insurance company or a mortgage company. And when we talked privately, his level, I believe that he said was 3,520. I think maybe our inputs were a little bit different. Maybe the inputs on our risk-free rate that we used, the interest rate that we used to model, because interest rates do affect valuations. And so, when I had calculated it a couple months ago, I got around 3,600. He confirmed it at 3,520. So I think that's a good level. So anywhere between 3,500 to 3,600, definitely I see that as being the institutional value level where we may see some buyers come back into the market. And if that's the case, I just want to be prepared for it. Again, if we break that 4,000 and the VIX keeps spiking and we see that continuation, I may buy maybe some September put spreads. Possibly, I don't know yet. It depends on really what we see tomorrow and what kind of price action we get after the CPI report comes out. But for example, the 3750, 3700 spread, a vertical debit right now for September expiration is about 23 in premium for 50. No, that's not. I might have to go a little bit lower. 37, 3650. So something like this, 3,700 to 3,650. Looks like it's about $10 for a $50 wide spread. So it gives me about 4-to-1 risk to reward. So we'll see. And hopefully we see a little bit of a pop. If I see that it pops a little bit up to 4080 or so, or maybe even 4050, and then we just have a hard time getting over it. And then I see put orders, buys coming through, and the VIX going up. I may just buy some spreads at that moment. So at that moment, then these spreads are going to get a little bit cheaper, because right now we're around, that 40-20 in overnight market. So if it pops up to like 40-50, or 40-80 or so tomorrow, and then we start seeing those put orders coming in, VIX going up, I may buy into that spread. Probably it's going to be a little bit, maybe $10 or maybe a little bit less on that $50 white spread. You can always do it on SPY too. For those of you who have smaller accounts, or prefer using SPY over SPX, which is definitely understandable. Even for those with bigger accounts, a lot of people prefer using SPY. You can, I see here 370 to 365. Yeah, it's little bit over $1. I mean, it closed. This is as of market close earlier in the session. But if we pop up to 40-50 or so, I imagine that's going to get a little bit cheaper. And I might take that hedge. We will see. Or I might take an equivalent in IWM or Triple Q. I don't know yet. And I'll definitely post later on once the CPI comes out, and once we see what happens to the equity markets in reaction to that. Again, I'm not trying to predict the future. I'm just anticipating what may happen, just based on what we saw today. And I just wanted to put this video out before the market opens. I wanted to update the plan. Seeing as we're getting some unexpected price action, I thought it was fair. I thought it was only fair that at least I put out this video so that you all can update your plans as well too, so you all can also anticipate and try to make 5 or 6 moves ahead of time, or at least plan for it. So just wanted to give you guys that update, and hopefully we'll see what happens, and hopefully we'll get an opportunity to really hedge for the downside. I'd love to get an opportunity to hedge again. And, there's still a possibility we can still go up. If VIX really collapses after that CPI report, I can still see it going up. I think the chances of that are quite low, though. I think most likely, even if we do get a pop, we may see fresh hedging coming around that level. Just because I can see a lot of investors saying, oh, they bought here, and they're really holding the bag, and I can see them selling some calls maybe to protect that and buying some protective puts at that level. So we shall see. So I just wanted to give you guys that update. All right. And if I see anything new, I'll try to come back and give you guys updates again. But definitely I'll be on our Discord when the CPI report comes out, and I'll try to give you guys some updates then. All right. Have a good night and stay tuned.